The premier property at a 160 Royal Palm Way, which is situated right in the absolute epicenter of America's wealthiest enclave, just devolves into a rotting, hollowed-out concrete shell.
Right, with rebar literally rusting in the Atlantic salt air.
Exactly. Mechanics liens are piling up. You have these unpaid contractors legally attaching their massive invoices directly to the property's title.
And municipal code fines are compounding daily.
Yeah. And while this physical asset dies a very public death in Palm Beach, the primary developer is, well, he's actively sailing the Atlantic aboard a 151-foot mega yacht.
Within the next few minutes, you're going to understand the precise structural vulnerabilities inside an EB-5 capital stack that allowed over $44 million to be compromised. More importantly, you will walk away with the exact forensic indicators needed to protect your own capital from escrow breaches.
We are opening the private case files of Priyanshu Priyadathikar. He is the lead investigator behind the Midnight Ledger, and today we are looking at case log Palm House 160, U.S. v. Matthews et al.
And we need to establish right up front that Pry operates with a very specific combined power. He brings the macro-analytical weight of an institutional CRE advisor.
Along with the tactical, boots-on-the-ground execution of an active realtor.
Exactly. He doesn't just model the debt, he verifies the concrete. And that is exactly what is required to dissect a market anomaly like this.
Right. So let's look at the raw timeline. The primary developer, Robert V. Matthews, acquired this historic Palm House condo hotel property way back in 2006.
Yes, and the original ambition was a 5-star luxury destination. But, when the subprime mortgage crash hit in 2008, the debt obligations just asphyxiated the project.
And that happened to everyone, right?
Sure, but Matthews lost control of the site to foreclosure in 2009, and the lenders remembered him. Palm Beach town officials remembered him. He was completely unbankable under his own identity.
Which forces him to become a ghost in his own deal.
Precisely. By 2013, the asset is still distressed, and this is where we see the execution of a straw entity fraud tactic. Matthews engineered a shadow acquisition to hide his identity.
So he just sets up a front.
Yeah, he used his brother, Jerry Matthews, to front an LLC as a straw buyer. So, Jerry quietly repurchases the debt and the title.
So it's basically like a financial phantom. I mean, he's wiping his fingerprints off a failing asset only to re-enter the market wearing a borrowed face.
That is the perfect analogy. And that structural deception laid the critical groundwork for the massive capital raise that followed. It artificially reset the risk profile.
Let's break down the core mechanics of Pry's findings inside the ledger. How do you raise that kind of capital for a tainted asset?
You target foreign capital. Matthews and his partner, Joseph Walsh Sr., utilized the EB-5 Immigrant Investor Program. They solicited funds from over 70 foreign investors.
Mostly from China and Iran, right?
Correct. The pitch was $500,000 each, plus administrative fees in exchange for U.S. residency.
Which completely shifts the psychology of the investor. They aren't just looking for a preferred return, they are buying a green card. But the marketing materials they used were just outright lies.
Completely fabricated.
They claimed former presidents Donald Trump and Bill Clinton were on the advisory board, along with these major corporate titans.
And neither president had any involvement whatsoever. But to a foreign investor, that fabricated pedigree manufactures unquestionable authority.
Still, there are safeguards. I mean, institutional capital relies on structure.
Right. And this is the structural failure focused on the escrow breach. The investors had written guarantees that their $500,000 wires would stay safeguarded in a third-party escrow account.
So the money isn't supposed to move.
Exactly. It was strictly tied to regulatory action. The funds were not to be touched until the investors' Form I-526 petitions were formally approved by USCIS.
But here is where his investigation takes a completely unexpected turn.
The syndicate bypassed the escrow entirely.
Wait, really? How do you bypass a legally binding, time-locked vault?
By exploiting internal complicity. Almost instantly upon wire deposit, they drained the capital. They treated the escrow not as a restricted holding tank, but as a completely unrestricted slush fund.
Moving on to our next major pillar, how Pry systematically navigated these operational hurdles. Because tracking that vanished capital requires a very specific methodology.
It does. Pry uses what he calls a capital siphon model to project real-time construction collapse risk. In this report, Pri uncovers exactly how the numbers fell, and it's staggering.
Give me the breakdown.
Out of the $44 million raised, an astonishing 68%.
$8 million for actual hard and soft construction costs.
Yes, meaning $29.92 million became diverted luxury capital.
Let's talk about where that $29.92 million went, because the ledger details a truly grotesque misuse of funds. We are talking about a 151-foot mega yacht named Alibi.
Which is incredibly expensive just to dock and staff, let alone purchase.
Exactly. And Matthews was bailing his multi-million-dollar private estates in Palm Beach and Nantucket out of foreclosure. He bought 2 residential properties in Washington Depot, Connecticut.
Using EB-5 capital.
Yeah. And just paying off hundreds of thousands in personal American Express bills for himself and his wife, Maria.
Which highlights a major vulnerability in conventional underwriting. How Pri saw what the spreadsheets missed is fundamental here. Pure spreadsheet underwriters often assume capital is deployed where it is legally promised.
They assume the paper tells the truth.
Right. But Pri's forensic methodology looks for the physical disconnect between the capital flow on the ledger and the actual on-the-ground progress at the site.
If a spreadsheet says $10 million was drawn for structural framing, but there are 0 cement trucks on site, the spreadsheet is a fiction.
Precisely. You cannot audit an asset purely from a desktop.
And what Pri is reporting from the ground in central Ohio is how these forensic lessons scale to active markets today. He applies the structural autopsy of this Palm Beach disaster to track macro shifts, yield compression, and hyperlocal RevPA trends in the Midwest.
Proving his precision across entirely different markets. Which brings us to the broader shift and the critical what-if sitting inside these numbers.
Look, I have to push back on the operational reality here. This is Royal Palm Way. What happens if the municipality steps in sooner?
They really can't. Not financially.
But when a $44 million project becomes a rotting concrete eyesore, accumulating millions in town code enforcement fines and unpaid mechanics liens,
the asset just collapses.
Yeah.
Pri's investigation into the ledger shows that because the capital stack was completely compromised from day one, construction simply halted, leaving the blighted shell.
so the town is just writing tickets to a ghost while the money is already gone.
Exactly. The reckoning had to be federal. It triggered joint investigations by the FBI, IRS, CI, and the SEC.
And the fallout was massive. In July 2023, Robert Matthews pleaded guilty to bank fraud, wire fraud, money laundering, and tax evasion. He got a 65-month federal prison sentence. That's 5.5 years.
His brother Jerry and his wife Maria also pleaded guilty.
But what about the site itself?
It eventually found rebirth, but only after total liquidation. London and Regional Properties bought the stalled property at a 2019 bankruptcy auction.
And they didn't even try to salvage it, did they?
No, they demolished the blighted shell completely and built a premier luxury boutique hotel from scratch.
As Produce points out in this week's Perspective, this forces a massive debate about the friction between spreadsheet profitability and fiduciary reality. When debt markets freeze around a toxic sponsor, who ultimately bears the risk?
Right. Is it the foreign investors who lost their money and their visas? The municipality dealing with the blight? Or the distressed asset buyer who has to demolish a ruined structure?
The risk is socialized, but the capital was privatized into a mega yacht.
Which brings us to the strategic bottom line for institutional owners, PE groups, and developers. An unsecured escrow is not just a regulatory violation. It is a fatal structural flaw that guarantees catastrophic project failure.
You cannot model your way out of it.
No, you can't. And that is exactly why Priyanshu Adithacker's dual authority approach is essential for navigating high-stakes commercial investments.
So here's the Ledger's sniff test for you tonight. If you're holding this distressed note and discover the sponsor mascot deferred CapEx behind temporary concession gimmicks, do you accelerate foreclosure and risk asset reputational blowback or restructure to buy runway? Drop your strategy in the comments below.
But the analysis doesn't stop here. If you want to dive deeper into the data before the next bell rings, make sure to hit that subscribe or follow button right now in your favorite podcast app. If you found value in tonight's reporting, leave us a 5-star review. It helps other listeners find their way to the table. For exclusive updates, show notes, and deep dives, visit our website at bearinvestors.com. Until next time, stay sharp and keep your books balanced.